Good morning. Tuesday the 5th. This is what's going on. The situation in the Gulf a little calmer this morning after yesterday's fighting. Oil prices have gone up and, to be honest, largely stayed up. The US 30-year has hit 5%. The Australians have hiked by 25 basis points. On the corporate front, HSBC, Rheinmetall and Santander have all missed. UniCredit, though, Tom, delivers a beat.
So geopolitics and earnings a factor for the markets. Then we continue, of course, to look at the oil price, currently down 0.9% on Brent at $113 a barrel. We continue, to your point, Guy, to watch what's happening in terms of the relationship between higher oil and the yield story and the bond sell-off. So there's the fresh pricing then. Japan was closed, so you didn't get the trading until now. 394, a little bit, very, very modest gains in terms of the 2-year. But given the sell-off yesterday, of course, with yields higher, the focus. And as Guy was saying, the 30-year at 5%. Euro Stoxx futures pointing lower by just 0.1% after losing almost 1% yesterday. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's 7:01 here in London, Tuesday the 5th of May, and Monday was marked by many tests of the fragile ceasefire that has existed for the last month in the Middle East. But Monday we saw many tests of that. The US fighting off Iranian drones, missiles, small boats. Crucially, though, 2 US-flagged vessels managed to transit the Strait. 2 US destroyers managed to transit the Strait. The UAE intercepting missiles, suffering drone strikes at their port in Fujairah. So we catalogue a number of attacks that pushed oil prices once again higher after we'd seen that drop at the end of last week. And I suppose what the markets are watching for is whether we're going to get any further short-term escalation here. That's certainly what we're watching as we wait for the US Defence Department to deliver some kind of briefing to the global media. And does it matter that we saw the transit of the Strait by US destroyers and vessels? We will see whether that is material for oil markets or not.
Everybody's telling me, everybody that sits around this table that comes and joins us tells me that it's going to get better. Feels like it's getting worse, doesn't it? Once again. Isn't that the narrative that we got out of yesterday? We're back to fighting. Oil prices are going in the wrong direction. Isn't that the narrative that, yes, maybe a few ships have got through? 130, wasn't it, before the crisis started on a daily basis? The situation getting better? Is this going to be resolved anytime soon? Every fund manager, the portfolio manager that comes and seems to sit around here tells me it's about to get a lot better. Doesn't feel like it this morning.
That is the huge disconnect, isn't it? Is that bias in the market towards a view that this will be resolved, that the incentives are there on both sides to resolve this. But right now, to your point, we are seeing escalation, not de-escalation. How can you call it a ceasefire when you're not ceasing firing?
That's the joke, isn't it, this morning?
And Tina Fordham, a geopolitical analyst, of course, quoted in John Author's piece this morning saying, the outcome is either a long and messy war or a bad deal and a humiliating deal for President Trump. Now, that's her view. But this is, seems to be a track that is heading towards escalation rather than de-escalation. You have the likes of Lindsey Graham in the US saying we need to start striking Iran again.
Right, yes, absolutely. And so with that kind of call in mind, we'll watch what Pete Hegseth has to say later on today. Goldman Sachs then sounding the alarm, not about the broad oil markets, but about specific products. And this is just the continuation of a theme. We've been focused on these for a number of weeks, months even. Naphtha, jet fuel, LPG. These are the things that over at Goldman Sachs they are now particularly concerned about, and they're concerned about the speed of the drawdown in these particular products.
It was interesting, Vanessa Hudson over at Qantas talking about the fact that she's actually a bit calmer when it comes to jet fuel. I wonder whether the Chinese are beginning to release a few products into the market, maybe easing the Asian situation. Let's talk about the market reaction to all of this. So this morning I see S&P mini futures are up, which I think is interesting because apparently the CTAs are meant to be selling this week, but we are up despite the fact that we've got a 5% 30-year in the United States, which we still have this morning. Let me just go back to my bond market screen. Still, north of 5% on a US 30-year. The last time we had the US 30-year at 5%, we dropped by 6% in stocks. So we're not seeing that, which is interesting. So this disconnect between stocks and the bond market, I wonder how long that tension can last for, because every time we've got to these kinds of levels, we've seen stocks being pushed lower. Is this time different? How much higher do we need to go? How long does it take to go? It's taken a while to get from 4 to 5. How long does it take to go to 5 to 6?
And I wonder if the European and US stories diverge here, because does the bond market and the inflation concerns, the higher oil price that's being exposed there, does that have more an impact on European stocks because they don't have the underlying positivity of the AI investment cycle and what that is doing to earnings? Because the earnings story out of the US has been quite incredible, based, versus its own recent history.
And we're now fully priced fully priced for a hike from the ECB in June. We had the RBA decision, the third straight hike in a row. It sounds like they may be on hold, but of course they've been an outlier. And to what extent and for how long is the RBA an outlier as we consider the inflationary impacts of what is happening?
It's I don't know. What do you listen to right now? Is it the bond market or is it the equity market? They can tell different stories for a while. Can they tell different stories?
And they can tell, different geographies can tell different stories for a while, but do they end up uniting? We're pricing out rate cuts in the States, aren't we? We are now pricing a 70% chance of a Fed hike by April 2027. Barclays is joining Morgan Stanley in pricing out the cuts that they had been seeing. And this in the face of some still consistently dovish commentary from some at the Fed. I mean, John Williams, for example, one of the voices at the Fed that seems to be not commanding the markets at the moment.
Shall we see to what extent the earnings story commands the markets today as well? Because we have had some significant earnings crossing. We've had the likes of HSBC, Zabadell, you've had UniCredit in the banking space, and in the defence space, Rheinmetall. Let me just give you a few details in terms of UniCredit, because a very strong beat, and then implications in terms of the deal-making in the financial sector, in the banking sector in Europe, obviously giving Orcel arguably a stronger hand. So the top line's coming through for UniCredit. Its highest quarterly profit ever for the Italian lender, net income increasing 16%, and again on the week where that potential takeover, at least that's the aspiration for Orcel, of Commerzbank is front and centre again.
More broadly, though, we've got a defence story that actually, I think, going forward looks quite positive, but the numbers out of Rheinmetall this time round, probably not so. Defence companies are very lumpy in terms of what they deliver. Orders come through different times, different kind of sequencing a defence company in terms of what you get on a quarterly reporting is quite difficult, I think. So it's interesting. I don't know whether you focused this morning on Rheinmetall's outlook or whether you focus on these numbers. Yeah,
and when you're looking at the first half of the year, they're guiding towards the second quarter being more significant than the first, to your point, and we're not going to get the full numbers until the 7th of this month, are we? So we'll watch out for that. HSBC, the story there is really interesting. A credit loss that seems to be quite substantial. A fraud charge in the UK, which seems to be quite substantial, $400 million. This fraud charge is linked to what the bank described as a fraud-related secondary securitisation exposure with a financial sponsor in the UK. There are a lot of things. There are a lot of things that seem to intermediate the relationship between HSBC and whatever this risk is. But they are certainly taking a charge on that. But interestingly, and perhaps more interesting, I'm not sure, but similarly interestingly, they're recording a $300 million increase in the allowances tied to the deterioration, the just general deterioration in the economic outlook. And this is something we picked up on last week with some of the French banks, this sort of macro reassessment of the risks leading to a need to take charges against doubtful debts.
And that's going to be, I think, a narrative that is going to become increasingly important. Once the banks start talking about it, you know that maybe it's starting to get embedded into the system. Got some great guests lined up. We're going to talk trade in a few minutes' time. So we've got the French Trade Minister coming up. There is a lot going on when it comes to the trade narrative right now. And the French have been pushing pretty hard for some fairly strong reactions to what we've seen coming out of the United States. Cars are the latest flashpoint. Madison, JPMorgan, private bank global investment strategist, joining us later, as will be Mark Pinto, Moody's Ratings Private Credit's global head. Again, a lot of commentary, particularly coming out of Milken overnight, talking about what is happening in that space. So we'll follow up and get an update on what his views are.
Here's a look ahead to what else we are watching throughout the day then. The ECOFIN meeting starts in Brussels. We'll be across that for you, of course. Talking of the Milken Institute, as Guy was mentioning it, the global conference, of course, we're going to hear from BlackRock's Larry Fink at that event and Brookfield's Bruce Flatt as well. And at 3 p.m. UK time, we get data out of the US on ISM services, jolts as well on the labour market and US earnings with Pfizer before the market and AMD, of course, in the AI chip space aftermarket as well. And on Fed Speak later today, we're going to hear from Michelle Bowman and Michael Barr. So mark that for you as well.
What else we got coming up? We need to talk about what else is going on around the world. Bloomberg has learned that Apple is considering using Intel and Samsung to manufacture the main processors for its devices in the United States. Now, such a move would, of course, reduce reliance on longtime partner TSMC. Sources say talks, however, have not resulted in any orders so far. Apple apparently has concerns about using non-TSMC technology and may not ultimately move forward with another partner. Palantir has raised its revenue outlook for the year to almost $7.7 billion. Now, that far exceeds analyst estimates. Sales, though, in the first quarter rose to a record, but US commercial sales fell short of expectations. Palantir shares fell in after-hours trading. That said, its stock has been punished in recent months by investors who have pulled back on the software industry more broadly on fears of AI disruption. So to see that in context. And the European Union is seeking to get access to Anthropic's powerful new AI model, Mythos, to test vulnerabilities in cybersecurity. EU Economy Minister Valdis Dombrovskis says the bloc is in talks with the firm about Mythos. Officials are worried that without access, Europe's financial system may become exposed to digital attacks if the technology falls into the wrong hands. So there's a couple of things to say here. One of which, I spoke to Sergio Motti about this story the other day, and he said, actually, our technology partners have access, so we're not worried that we don't have direct access. So maybe, actually, this is less of a concern for European banks than maybe the politicians worry about. But nevertheless, it's got to be. If US banks get it early and the rest of the world doesn't, does that put it at a competitive advantage? Yeah, I mean, and we've seen other reporting suggesting that the White House wants to get more involved in approving models, and does that mean the rollout of those models as well? And what does that mean if the US government sees this as another geopolitical tool that it can flex, a geopolitical weapon it can wield in the same way that we've seen chip exports very much become part of that.
We should just meditate on that potential change then that's been reported by news organisations in the US around the White House thinking about putting in some measures via an executive order to actually have greater oversight of these models, and it seems like Mythos was the trigger. This is a significant pivot for an administration that had taken a very hands-off, laissez-faire approach to AI development, precisely to your point, Anna, to get that geopolitical lead over China. And now they've woken up to the fact that there does need to be some form of guardrail put in place, some form of oversight. And interestingly, they're looking at the UK model for safety of these AI models and oversight, and whether or not they can replicate that to some extent. Again, according to the report. I'm assuming they don't get access to Chinese models. The Chinese can release whenever they want and do whatever they want. So, again, that speaks to this arms race. I don't know what the Chinese guardrails are like, but I would imagine that Chinese authorities have fairly clear oversight as to what is happening here. So it's going to be interesting to see kind of what different jurisdictions do. Yeah. A lot of complexity to calibrate. Coming up on the programme then, Apollo's John Zito says private credit is a safer place for investors, even as AI causes disruption fears. We will discuss the risks ahead for private credit. Plus, we'll take a look at the stocks to watch at the open, including the defence firm Rheinmetall, the German company reporting revenue and operating profit below analyst expectations. Up next, we will be joined by Stuart Bennett, G10 FX strategy head at Santander CIB. We'll talk about where the dollar goes next from here. Is it still the haven? Do we need that kind of haven right now on the 5th of May? IB plus BBTV Go. That is the function to use on the Bloomberg terminal to get in touch with the team. This is Bloomberg.
We've got some production in Kuwait and Saudi Arabia that has been slowed down as we don't have the ability to evacuate it out of the region, and storage is filling. So we've seen some reductions in rates of production. We produce natural gas offshore in the Mediterranean that supplies Israel, Jordan, and Egypt. Our facilities there are running at full capacity.
Chevron CEO Mike Wirth, of course, speaking to Bloomberg there, and sticking with the oil sector. Oil has edged lower, pairing Monday's gain as traders track tensions in the Middle East after fresh clashes between the US and Iran. The round of hostilities cast doubt on the 4-week ceasefire and came as the US sought to clear a path through the Strait of Hormuz. Let's bring in Bloomberg's Jumana Basechi, who is in Dubai. So the US attempting to clear a path. The ceasefire looks extremely fragile, Jumana. Where does this leave the ceasefire? What are we looking ahead to?
Yeah, well, once again, it's looking very tenuous, Anna, and indeed things have taken a turn for the worse in the last 24 hours. It was only a few hours after President Trump, what he calls President Freedom, that campaigned to help guide stranded vessels through the Strait of Hormuz, that we saw a significant rise and intensification of attacks on the strait, but then also renewed Iranian attacks directed at the UAE. And I will tell you, as a resident of the UAE in the evening yesterday, we received received multiple missile alert texts throughout the course of the night. This happened after an ADNOC tanker was reportedly targeted by an Iranian drone, and then also emerged in the evening that an Iranian drone had also managed to intercept UAE's air defense system and cause some damage at an oil exporting facility. And this is the first time we get such an incident in, as you say, the 4 weeks since the ceasefire. Now, overnight, I will say that we have not had any official response yet. President Trump gave an interview to ABC, and he didn't actually directly say that there had been a violation of the ceasefire, though clearly what happened in the last 24 hours was exactly that. At the same time, CENTCOM are painting a positive picture about how successful Project Freedom is, saying this morning that 2 of these U.S. Navy destroyers managed to successfully make it through the strait despite Iranian attempts to stop them. President Trump saying that they have targeted some of those small, fast-moving Iranian boats. And so what's happening here is the U.S. are clearly trying to forcibly reopen the strait. This morning, the Iranian side are saying that Project Freedom is Project Deadlock. This is a post that's put up by the Iranian Foreign Minister Abbas Araghchi. Events in Hormuz make clear that there's no military solution to a political crisis, and then says talks are making progress. So at this juncture, President Trump, and it is really President Trump, has to make a decision. Do they go down the path of further military escalation? Do they support their key ally in the region, UAE, that was once again susceptible to these attacks? Or do they push once again for a diplomatic breakthrough? And if they do that, what does that mean for the lifting of both of the blockades around the Strait of Hormuz? Because Iran have time and time again asserted that they will not go into a second round of discussions unless the U.S. blockade is lifted. So again, it is an impasse, but President Trump has to make a big decision. Later today, there's going to be a briefing by Pete Hegseth that is at 8 a.m. Eastern time. So we'll hear what they have to say about how they think the operations are going.
It's interesting to hear President Trump describe it as a mini-war overnight, changing language maybe. Jumana, thank you very much indeed. Jumana Basekci joining us out of Dubai. Stuart Bennett is the head of G10 FX strategy at Santander CIB. Good morning.
Good morning.
I've got oil prices up, kind of circa 1 to 13 on Brent. I've got a US 30-year, circa 5%, north of 5%. What does that all mean for the dollar?
Well, it means there's still risk out there. And it does mean that the dollar has shown itself again to be the main safe haven.
Yep.
So, whilst, the market's sort of trading off, news headlines, the underlying pressure is still that there's, a lot of uncertainty out there. So you have to be cautious about being certainly too short the dollar. Being too optimistic, I would say, about what's happening in the Middle East.
Is there a rates relationship? How strong is the rates relationship right now? If we've gone from 4 to 5, kind of quite slowly. If we go to 5 to 6 on a US 30-year quite quickly, does the rates relationship story come back into the FX landscape? I
mean, intuitively it should. It is sort of the main sort of first go-to correlation, if you like. But since the war started, the conflict has started at the end of February, that relationship has really not been very reliable. And in terms of the euro-dollar, it's virtually sort of broken down to zero. So effectively, you might get an ECB person say we're going to hike rates, and the market might want to remember how it used to react to that and think, let's buy the euro. But it shouldn't be doing that, and it's not doing it, because it's got one eye on what that will mean for European growth.
Yeah, absolutely. So the market then, Stuart, just to reiterate that, the market, in terms of watching the euro, any hikes that we get from the ECB are not likely to support the euro. They're likely to, emphasise downside risks for the Eurozone economy? Yeah,
I think so. And I also think, even just a couple of weeks ago when we had the IMF World Economic Outlook, you still got the US growing, or expected to grow, at twice the pace of Europe. Last year, you had the dollar come under pressure because they thought the Fed were going to cut rates and the new Fed chair was going to be very Trump-friendly and cut rates. That's not the case anymore, so those things sort of go in reverse from the US and dollar side, but also it is that growth story from the European side with the interest rate hikes. And the more you have actually priced in for the ECB, even if they don't happen, the more it should be a negative, I think, currently for the euro. That could change when the correlation re-emerges, and it should, but for the past couple of months, it's been more or less zero.
And thinking about that interest rate decision in the States and how that might influence the dollar, although accepting all the other things you've said about the haven status being in the driving seat, are you assuming then a cut in the short term, but maybe not as much as we were expecting, and then a hike more quickly than we'd anticipated? That seems to be the two dynamics that I'm reading about this morning over different timescales.
Well, our US economist has been very consistent about this. He's never thought that the Fed would cut rates, even last year when the market was pricing that in. So he's always sort of seen, nothing really happening, this year, and then, obviously next year, different story, but getting back to it. But certainly he's been consistent that he doesn't see, a rate cut, and wouldn't, even regardless of who became the Fed chair. And I guess the inflation story as it currently is just really intensifies that there's no real need for the Fed to pull the trigger there.
Is to the pound, is the pound vulnerable to political risk in the UK, or is that all priced in at this point?
I'm not sure if it's priced in. I mean, I'd probably go back to November when we had the budget and we had similar sort of political concerns which are weighing on the pound. When you were there just before the budget in November, cable, for example, was much lower, and the position of speculators was much more net short cable. So once you got to that event risk, the budget, and people were quite relieved, there was scope for it to sort of come back off those lows. I'd say the worrying thing about the elections at the end of this week is that cable is higher, and that positioning is not quite so net short. So there is some scope for people just to say, let's take a bet, political malaise, political uncertainty, the pound could weaken. But it's in a better position, an easier position to do that, as opposed to the last political problem at the November budget.
What would the downside move for the pound look like if you got a change of leadership on Friday?
Well, I mean, I think Friday might be a little bit too early for that. Maybe next week. I think it would depend on first of all, it's uncertainty. So I think that'd be knee-jerk negative. I think then, reading some stories on Bloomberg yesterday about gilt traders getting worried about if there is a new prime minister, is it more left-wing, is it more fiscally expansionary, and those sort of issues will weigh. But I think it's just the uncertainty thing that will be just an easy move lower on sterling, almost come what may.
There was an expectation that maybe the Japanese would use the long weekend, which they're still in, to maybe intervene a little bit more. They didn't. There's been hints of it. Do you think the intervention is going to be effective? Other than a rate hike, what can the Japanese do at this point? And do they need to get further than a rate hike? Do we need a series of rate hikes to stabilise the yen?
Well, I certainly think they need to hike rates. I think the inflation story there, even before the oil price shock, was solid enough for the Bank of Japan to move their rates, higher. So it's probably the minimum requirement, I think, to sustain minimum to sustain any sort of strength in the yen. I think this intervention move, they tend not to last if it's just one, if it's solo intervention. The market, when the dust settles, will probably just try to pull dollar yen higher. And if we're right about the dollar also being stronger, then that's going to be working against it. But it's been reasonably steady over the past couple of days, so I think they'll take some comfort in that at least.
Anything we learn from the Aussies at the moment and what they're doing? Hiking rates, but the story was kind of in train already, not necessarily a huge amount of read across, or is there, into what other central banks can be doing?
Probably not. I mean, they didn't do a great deal last year, and they've now sort of reversed all they did in terms of cuts. They are, in a way, in a slightly different situation because they do have that dual mandate about an inflation target which is a little bit higher than other central banks, but also keeping an eye on growth and employment. So, I mean, I guess going forward, look, you said that. We're in a pretty good place at the moment, so not rushing to do anything. But again, it will be that focus on not just inflation, but also what to do into growth and employment, and waiting for the budget, next month, see what that does.
Stuart, thank you very much indeed for your insights this morning. Stuart Bennett, head of G10 FX strategy at Santander CIB. Coming up, G7 trade ministers set to gather in Paris tomorrow amid growing strain, of course, on the US-EU trade relationship. We're going to speak exclusively to the French trade minister, Nicolas Forissier. That is next. This is Bloomberg.
Tuesday morning. Good morning. It's Monday for London, so just bear that in mind when you take a look at what you're seeing in terms of the futures picture this morning. London's playing a little bit of catch-up in terms of the session we are watching. You've got FTSE futures down by 1.1%. Elsewhere, so US futures are positive. We didn't quite close at US lows yesterday, but quite close. US futures are ticking higher a little bit this morning, so I'm going to park the FTSE. Now, elsewhere, you've definitely got some underperformance coming through from Germany this morning, some outperformance coming through from Italy. I wonder whether that's going to be UniCredit. But by and large, you are seeing a market that looks like it's going to open a little bit softer, and it's going to be interesting to see what the nuance is around some of the banks in particular this morning.
Yes, it seems as if the bond market story is pausing a little bit, just as maybe the US stock story is pausing. The bond market story globally is maybe pausing a little as well, because yesterday we saw the bond markets here in Europe, European government bond markets, very much reflecting that higher yield story that we've talked about already in Treasury markets. That sent the 30-year in the States above that 5% level. We were up by 5 to 8 basis points across the European bond markets at the 10-year tenor yesterday. So that is a little bit yesterday's story. And so as oil prices pause, we pause on bond markets as well.
Trade is in focus, of course, the trade tensions between the US and Europe. Europe will consider all retaliatory options if President Trump raises tariffs on cars and trucks from the EU to 25%. That is the warning from the bloc's finance ministers, though several officials have urged restraint. The growing strain on the transatlantic trade relationship comes ahead of the G7 trade ministers meeting in Paris tomorrow. Joining us now for an exclusive conversation is Nicolas Forissier, the French trade minister. Minister, thank you for your time this morning. I want to start by asking, how deep is the level of distrust right now in Brussels when it comes to that relationship with the US?
Well, I mean, we have a relationship which is sometimes very difficult to follow because the Americans, Mr. Trump, are making some declarations. I can imagine that the declarations have political aims or economic aims. What is important for the European institutions and the Commission and the Parliament and the Council and the ministers such as me is just to try to build something which is predictable, which is reliable, and which is based on the Turnberry Agreement we had last July. So we are just trying to build and discuss with our American friends, even if sometimes we have to follow an up and down strategy. And this was the case, for example, the announcement by President Trump on the cars, possible 25% tariffs that he announced last week. So today there is nothing which is decided. We are just trying, apart from this declaration, to go on building a strong relationship which is predictable for the enterprises.
How forcefully would you like the EU to respond if those tariffs are raised to 25%?
Well, we hope this won't be the case. And we've said to the Americans and the American authorities from the beginning that what was important was the Thornberry Agreement. There was a deal, there was an agreement last July. And so now we have to implement it. Sometimes I hear that the Americans are reproaching European institutions to be quite slow, to take time to discuss, to have the Parliament amendments. But this is the normal process in the European institutions. It's normal that the Parliament gives its opinion because it represents directly the people. So this takes time, but it's moving at a normal pace if I compare it to other laws, and we will implement what was in the deal. So we are waiting from the Americans to do the same. And if we in the Parliament are just putting some, for example, sunset rise or sunrise clause, it's just because the Parliament is doubting on the attitude of the Americans, and the announcement by President Trump doesn't help, even if I can understand that he does it, but it doesn't help. And so we have to build it progressively and to try to find the good way to implement the agreement, because what is important, and this we will discuss of it, of course, during the J7 meeting on trade questions, but what is important is to give some predictability, some reliable situation for the economics and for the enterprises, and this is what we are working on.
Yes. Minister, good morning. Is it realistic that we have a predictable regime for tariffs, Minister? I mean, looking at the US has 2 ongoing 301 investigations into the European Union and others. That could lead to more tariffs. So are we ever going to get to a place where we have a predictable tariff relationship across the Atlantic?
Well, I understand your question, and you've noticed that the economic and trade questions in the world today are very chaotic, very, it's the same as tectonic plates, you know, that are moving, and everybody's trying to push its advantages or to defend its situations. What the Europeans say, what France says especially, is that we have to be resilient, determined to find some peaceful solutions. It's not possible to have a normal and growing prosperity if we don't build this. So I understand that the Americans are asking a certain number of questions. They have the inquiries and so on. We sometimes have also inquiries. We will use our tools, especially if there is too many threats on our economy or on our industrial strategic interests. For example, I'm thinking of steel. So we will no longer be naive, but the idea of European institutions and of all the European countries, but also others, I mean Japan, Canada, Australia, I was there last week, we are all willing to have the willingness, to build something which is reliable. So this means that we have to discuss, and the J7 is one of the places where we can have discussions, frank discussions, try to find what is in common, try to build some tools, especially on critical minerals or rare earths, for example. This is the place where we have to work, and this is what we are going to do during 2 days in Paris.
Yes. Do you think that European countries, including France, Minister, will have reason to reconsider digital services taxes? Is that going to be something that Europe contemplates, thinks about? They've been criticised, of course, most recently by Jameson Greer, the US Trade Representative. Do you think that reconsidering those is sensible?
I mean, I know this is very permanent question on the other side of the Atlantic Sea in the United States. Digital services, taxes on digital services. Every time I meet an American friend, they told me about it. They tell me about that, but in fact, what we have to see is that I think the position on taxes on digital service are very reasonable in Europe. And even in France, we had discussions during the last budget bill in last autumn. Some MPs wanted to put, for example, 15%, even more, as taxes on the digital services. The government was very more cautious, very prudent, and said no. And in the end, we have a very small, smaller tax on the digital services. But I mean, Americans have to understand that we also have the right. Yep. They are doing it on many other subjects. So we have the right just to say that the big companies have to participate to the economic efforts and modernization of the European infrastructures, even in digital. So this is part of a normal game. What is important is that it has to be reasonable.
Minister, good morning. It's Guy. I can hear you perfectly.
Hello.
A few weeks ago, the UK managed to get a significant reduction in tariffs applied to Scotch whisky because the King went to see the presidents of the United States. What did you make of that? Does that kind of speak to the unpredictability of the nature of trade at the moment? And do you think the threat of significant tariffs on French wine and spirits still exists? And if the UK gets the kind of deal that it's got, how do the French counter that?
I mean, we've already had some threats on our champagne, for example. When I was in Davos. I arrived and I was told that President Trump had announced 200% on champagne. But on the day after it was 100, and the day after it was nothing. So the question is not what we could call as declarations or some say threats. I just want to say it's just a manner, a way of acting of the President of the United States to push some political debates, and I can understand he does that. But what is important is the result, and the result is that we have not that. Kind of 200% of champagne. It's very important, again, to have a reliable relation, and especially on wine and spirits, which are a very important and very symbolic part of our trade with the United States for the French. It's very important for us. Of course, each time I meet an American responsible of the government, American government, I'm asking them to push the fact that in Turnberry Agreement it was previously decided that probably we would have an exemption on champagne and wine and spirits, especially from France and Italy, for example. So it's still an issue which is on the table, and I'm quite optimistic, but we have to discuss. That's normal.
Okay. Final quick question from me. Do you think there's a relationship between trade and the military story at the moment? The President of the United States is deeply concerned about the fact that NATO has not supported his efforts in the Gulf. And I'm wondering, as we start to see him talking about withdrawing troops from around Europe, whether or not the trade story will become part of that as well, part of the fact that he is annoyed with Europe. Do you think the trade narrative could change as a result of Europe's relationship with the Iran conflict?
But yeah, I think everything is linked, especially because the fact is that the Hormuz affair is creating big problems on international trade, of course. If you speak of the relations between the United States and Europe, I mean, we just have to come back to the reality. We are allies. We are allies. And we've been allied since the last Second World War. So we just have not to forget that. Of course, I can understand that we have discussions on the future of NATO, on the efforts that European countries are doing in terms of defense investment. But I think the last years have shown that France and the other European nations, especially I'm thinking of Germany, but it's true also, even if it doesn't belong any longer to the European institution, but it's true also for the Great Britain, which is very active. Mr. Starmer and the President Macron are very much working together with Chancellor Merz and other chiefs of states and government in Europe to try to build this big defense effort from Europe. So just take this into account. I'm not certain that the 25% threat on cars has something to see with the reality of the discussion on the future of defense, security, and the question of Middle East. And honestly, the European countries were not warned about this Middle East war and the first raids against Iran. But, for example, France has positioned some important defense, especially Navy forces in the region, and we are very much connected. We have treaties with certain nations in terms of defense, and we will respect them. But this just needs to have a more peaceable, if I can say, and more calm discussion on these questions, because it's the future of the world which is now being on the table.
Minister, we're going to leave it there. Thank you very much indeed for your time. We greatly appreciate the French Trade Minister, Nicolas Forissier. Thank you very much.
Thank you very much.
Tom.
Just get you up to speed on something else that's crossed in the last couple of minutes, which is Alphabet, the parent company, of course, of Google, kicking off a 6-part debt sale in euros. That's according to a person familiar with the matter. So the duration is from 4 years to 37 years. Again, this is Alphabet kicking off a 6-part euro debt offering, and just speaks to that spend that's going on and these megacap tech names raising capital to spend on infrastructure. And so this is a story we will keep across. But it's a reminder of that more debt, exactly, even on the balance sheet of a company like Alphabet that has a lot of cash flow.
Yes, absolutely. We will continue to monitor those debt levels and how they rub up against free cash flow for some of these big tech companies. With that in mind, let's think about interest rates. Policymakers, Fed policymakers, are weighing in on the economic risks from the Iran war.
The risk to both of our mandate goals has increased. The elevated levels of inflation, mixed signals from the labor market, and heightened uncertainty from the Middle East conflict present an unusual set of circumstances. But the current stance of monetary policy is well positioned to balance the risks to our maximum employment and price stability goals.
That was the New York Fed President John Williams speaking, and we will discuss more on the economic fallout from the war. That's next. This is Bloomberg. Welcome back. 7:49 here in London. So around 10 minutes until the start of an equity session, which will show two different dynamics. One will be the FTSE 100 catching down with the rest of the markets from yesterday, and elsewhere a little bit more calmness, calm versus yesterday at least. Let's turn to the markets in 3 minutes here on the opening trade with Bloomberg Executive Editor for Asia Markets, Paul Dobson. Paul, good to see you. I want to start with what's been going on with bond markets. We're over 5% yield on the US 30-year, and this was part of the story of Monday, and it had a bit of a global flavour to it as well. We saw yields going higher globally. Going over 5% on the 30-year, I see it referred to as a line in the sand, a tipping point, but I'm not sure where that takes us, Paul. What are your thoughts?
Yeah, hi, good morning, Anna. Well, of course, it's the oil price that's driving those yields higher because they respond more to the inflation outlook. And so the higher the oil price goes, the more people fear inflation will flow through the economy, and that will raise future borrowing costs for the government. It will, reduce the amount of stuff you can buy with your bonds when they finally come to maturity over that long term. And therefore, we've got 5% again on the US 30-year yield. Now, when you talk about the line in the sand, it is true, because over the last sort of year, 18 months, each time we've got there, it's only spent 2 or 3 days before it's turned around and actually had a bit of a rally. So it seems like that's a choice area for long-term investors to come back into the market. Is this time going to be different? Well, it sort of depends on the oil price, but definitely people are thinking about those longer-term views. They're looking at the losses that are racking up now on the bond market. Overall, indexes are, only a little bit down. But if you look at the back end, that's really where the long-term losses have come in the US Treasury market. But in things like gilts as well, it's been much more severe too.
What did we learn from the RBA today? Hiking rates once more. How many more still to follow?
Yeah, so that's interesting. They're way ahead of the rest of the central bank pack in that sort of inflation fighting kind of effort. They've hiked for a third time, as you're saying. But they're also talking now about the idea that maybe policy is starting to get a little bit restrictive. So actually, we saw a bit of a rally in Australian bond yields, a little bit more comfortable there. But I think that what it's telling you is the central banks, are going to have to follow in the wake of the RBA if they also get the same sort of concerns about inflation stemming and flowing through the economy. So the RBA is a little bit ahead of the pack. The rest we sort of saw over the last month, a bit like the 5 stages of grief. Some of them are coming to acceptance like the RBA. Some of them are still in that sort of mourning phase. So it might take a little bit longer before they wake up and smell the coffee.
Yeah, well, the 5 stages of grief. Paul, we're looking at the bond market. European bond market's relatively relaxed. No major ruptures. Yields are broadly down between 2 and 3 basis points. But if we are in this scenario where central banks are hiking and the RBA maybe has taken the lead on that front and yields are higher generally, that 30-year above 5%, what does that mean for the equity story, Paul, just briefly?
Yeah, I think that it adds to the risks for the equity market. You were talking just earlier about we've got another one of the hyperscalers coming to the bond market to raise money. People are still worried about how tech is going to be able to pay for all the data center build out, of course. So that's a factor to consider. And if we do get to a point where those refinancing risks start to rise again, that will eventually weigh a bit on the equity picture as well. So something to bear in mind for the future.
Paul, great stuff. Thank you. Paul Dobson, of course, from our MLive team. You can get, of course, more details and more analysis on the Bloomberg from that team. Let's get your stocks to watch this Tuesday and bring Chloe Melly. Chloe, what are you looking at? HSBC, top of mind.
Yeah, absolutely. HSBC could see some weakness this morning after profit missed estimates. So performance was really dragged down by an unexpected one-off fraud-related charge in the UK, but also by a generally deteriorating economic outlook because of what's happening in the Middle East. And so we have seen HSBC outperform its peers, but we could see a reversal of that this morning, and the shares are already falling in Hong Kong. So we could see the same thing happening in London this morning. Another bank that might be having a better day today is UniCredit, with profit hitting a record, thanks in particular to really strong fee income. And so that could boost the shares this morning and also boost the CEO, just as UniCredit is preparing to submit its takeover bid for Commerzbank. And so Bloomberg intelligence analysts have said that there is really strong profit momentum, but the real focus is going to be on that capital deployment because of those M&A ambitions from UniCredit. And finally, let's end with one last bank this morning, and UBS could also be on the move today as the Swiss government is considering different options for UBS's capital requirements, and that might mean that the government plan for those capital requirements could actually be watered down and could also see some delay as well in that process of several months. And so we could see this actually provide some welcome relief for UBS after what has been quite a mixed start to the year.
Yeah, welcome relief, but also prolonged uncertainty. Yeah, absolutely one to watch. Chloe, thank you very much. Chloe Melly with those stocks in focus. I mean, HSBC is certainly going to be something to watch in the London market, isn't it, after the numbers coming through there. But more generally, London has to catch up a little bit with what happened yesterday.
We were closed yesterday, as a result of which, yeah, we are going to see a little bit of a dip. It's still got to price in that Monday move that the rest of the Europe has priced in. Banks are definitely a big story this morning. HSBC, they're saying it's idiosyncratic, that fraud-related charge. Will markets look past it? Will investors look past it?
The open trade coming up with futures currently pointing up 0.1%. This is Bloomberg.
Couple of minutes to go until we restart Europe in full form. London will be back. Tom will show you the futures in just a moment. Yesterday's US session kind of fell into two halves, not quite two halves. This bit is the market looking at AI. This bit is the market realising that we've got a bigger problem potentially in the Gulf as fighting restarts. Yesterday, US equities come down. Europe kind of does capture some of that, so actually there's not a lot to price in, and then we basically just go sideways, Tom.
Yeah, European markets fell about 1% yesterday. It was the auto sector that was under pressure. Today, futures are pointing high by about 0.2%, with UK, of course, and FTSE 100 back. FTSE 100 futures, though, pointing low by 0.8%, and part of that, to Guy's point, is the catch-up trade to the losses of yesterday. DAX futures pointing out by around 25 points, off by 0.1%. Earnings also in focus, Anna.
Yeah, absolutely. Earnings in focus. And we'll start with the banking sector. HSBC, UniCredit, a number of the banks reporting today. So HSBC reporting profits that missed estimates, an unexpected UK fraud-related charge that they describe, as Guy says, as idiosyncratic. We'll see. It seems to be weighing on the stock, though, over in the Hong Kong session. UniCredit, though, perhaps in a better story to tell this morning as they still pursue Commerzbank. Let's think about Germany some more. Rheinmetall reporting numbers for the first quarter. The sales number missing average estimates. But is the market going to focus on that or focus on the first half of the year, and the company putting the emphasis on the second quarter? And AB InBev also in focus. The drinks company, volumes unexpectedly increasing as robust demand for beer in certain regions, one region that includes Mexico, in fact, offset sluggishness in the US and in China. So those are some of the corporate stories we're watching this morning, Guy.
I wonder if they're getting ready for the World Cup. Maybe that's a factor in the beer consumption story. OK, let's talk about these markets. London's about to reopen. We were off yesterday. We weren't, but you were. And as a result of which, we're going to see the market gapping down a little bit at the get-go. So the FTSE 100's got a bit to price in. Ignore the FTSE, basically. It doesn't tell you very much about today. It tells you more about yesterday. Elsewhere around Europe, though, we are anticipating that we are going to see a fairly flat session. There are a significant number of stocks that need to be priced in as well that have reported numbers this morning, fairly big names. Some of the banking names in particular are going to be in focus. It'd be interesting to see how HSBC, though, does maybe impact the FTSE 100 this morning. It's obviously a significant weight in that index. Stock 600 is barely barely budging this morning, so we're down by 0.1%. The IBEX opens flat. The CAC opens fairly flat as well, down by 0.2%. The FTSE is the outlier, but we can ignore that. The DAX may take a while to get going this morning. Number of names reporting numbers there. And the SMI, the inflation story, is beginning to pick up even in Switzerland, I note this morning. Right, Tom, what do you got on the sector front?
On the sectors, top of the list right now is energy, up 0.7%. So oil prices, of course, in focus. The volatility's come through. Brent is actually trading down 0.7, but at 113, so higher, of course, over the last 12 hours. So energy at the top of the list, up 0.6%. Construction materials up 0.5%. On the downside, pressure once again on the travel and leisure sector, and you can tie that, of course, to higher energy prices. So that sector is feeling a bit of pressure today, a bit of pain, down 1.1% so far. Banks, of course, with the mixed results coming through. Strength for UniCredit, but weakness for the likes of HSBC. Currently, that sector is down 1%. You can see HSBC is one of the biggest losers, if not the largest loser within that sector, currently down 5.3%, Anna.
Yeah, absolutely. And so the story of two banks really very obvious this morning. So HSBC down by 5.4%, UniCredit up by 2.7%, and very, very contrasting stories to be told this morning. HSBC taking that charge for, well, a fraud-related charge in the UK, secondary securitisation exposure, idiosyncratic, according to the CFO. That's part of the story, but they're also taking a charge because of the sort of bigger picture macro risk attached to the war in Ukraine. And UniCredit, on the other hand, beating estimates, and that stock up by 2.7% as it still tries to consolidate across borders in Europe.
Rheinmetall's up, not down. So to speak to that sort of lumpiness we talked about earlier, you are seeing maybe the outlook being the more dominant theme in terms of what the market is looking at this morning. You are going to get, with these big defence orders, some degree of quarter-to-quarter volatility, and I think that probably is what we're seeing this morning. So the market may be looking at the forward-looking indicators, and the stock is up by 2.2% as we speak.
Let's talk about what's happening in these global markets then. Madison Fowler joins us, global investment strategist at JPMorgan Private Bank. Madison, good to have you with us. And I want to start with, to start with what's happening with the earnings story, because I wonder to what extent you think that really can compensate for a lack of clarity, a lack of transparency, the inflation threat, the higher energy prices, all of which stem from us watching day after day what is happening in the Strait of Hormuz. But the earnings story has been strong, and the earnings story in the US has been incredibly strong for S&P names versus their history.
Sure. And so I think that when we are looking at the S&P 500's rally from the lows, we've seen a 13% rally, which is really remarkable. That rally happened within 11 trading days. And part of that comes from, the movement towards a de-escalatory scenario. But a lot of it, I think, comes to the fact that earnings are the fuel. So even accounting for revaluation effects, Q1 looks like S&P 500 companies will produce around, call it 15-16% EPS growth. And on top of that, we are seeing a decent amount of breadth in the sense that most sectors are producing earnings growth. And we're also looking at over 80% of the companies that are reported are also noting earnings upward surprises, which is well above the 5-year and 10-year averages. So this is a notably strong earnings season. But of course, there are some, I think, conversations to be had around concentration even within that.
Yes, conversations about concentration, so concentration around tech. I wonder how you're thinking about big listings still to come as well, and what that might do to appetite for various names within certain sectors in the States and maybe elsewhere. I mean, the SpaceX IPO is going to be huge. It's supposedly coming the middle of this year sometime. Is the market going to have some kind of indigestion? Is this going to lead to rotation out of other names into this kind of stock? How are you thinking about these big listings?
So I think that this speaks to the overarching theme that we've been monitoring for a number of years, in which companies are staying private for longer, which means they are accruing more value before they eventually do go public. And so I think that that's one reason why we do think it's really prudent for investors to balance both private and public market exposure in their portfolios. But when it comes to equity markets at large, I do think again that brings to the conversation the concentration within public markets, specifically around tech. And we are, I think, believers in that tech story and believe that tech is producing strong earnings growth, and not only that, strong margins on top of that. But I do think that at the same time, it's really important to balance that sector exposure, not just tech, but also industrials, also focused on financials and healthcare. So a play between both scarcity and I think also some value plays as well.
I just want to kind of push on or build on Anna's point about the IPOs of these mega names, the SpaceXs, but also potentially Anthropic is valued at north of $800 billion, so it could be $1 trillion IPO. The liquidity draw and what that does to markets in the back half of this year, if those two events occur, and how investors should think about that in terms of liquidity moving out and heading toward. How does that reshape the market narrative towards the back end of this year?
I think when we, look at any sort of large IPO listing like that, it's going to be really important to gauge what the market sentiment is around that. I think, in the lead up to 2026, we were looking at investors react to IPOs from a more positive standpoint. And so that I think will be ultimately a really good sentiment check for markets as we see these private companies do go public. And of course, we could always see, pockets of indigestion as that does occur. But I do think by and large for those investors, the best way to manage that is to ensure that they're balancing both public and private market exposure to navigate through that period of time.
Your first answer reflected on the fact that markets have been assuming a de-escalation when it comes to what's happening in Iran. We're not seeing evidence of that, and if anything, we're seeing evidence of an escalation. What does that... I mean, I guess there's a question about what that does to the IPO pipeline potentially later this year, but how comfortable are you with the disconnect in terms of the equity outperformance versus an escalating situation in the US, in Iran, and whether those two factors meet?
So I think we tend to think about the outlook in terms of scenarios. So in a de-escalatory scenario, I think you are looking at an environment in which you are looking at only a modest impact to growth and inflation, so relatively a resilient macro backdrop, which is, I think, offering that fuel and support for earnings, which we think can carry markets higher. I think when you start to talk about other scenarios, perhaps if you see oil, north of, 100 for the next few months, or if you were to see it, gravitate even towards, 140, that's a sliding scale of greater risk for both the economy and for markets. We think that kind of middle scenario around 100 is still manageable for equity market investors and for risk assets at large. But of course, I think that also starts to underpin, where you focus on. So the U.S. looks more resilient compared to Europe, for instance, which is a more energy, intensive economy, and as a result of that, its market would likely struggle a bit more. The scenario in which you'd see, oil at, 140, that's more of that recessionary type risk. So I think it's about balancing across the range of scenarios, and we want to be prepared for all of those. So that means, positioning for upside, but also, I think, allocating towards shock absorbers. So you can think of, fixed income if you were to see that downside growth scenario, but also, inflation, real assets if you were to see more, inflationary type risks persist.
What do you think of a US 30-year at 5%? You talk about kind of balancing a portfolio. Can I do it in bonds? Do bonds work if we're going to see higher yields?
So I think that it comes down to, where you focus on within fixed income. So as we've seen, longer dated bond yields rise over the course of the past few years, not just around this scenario, but around rising fiscal risks, volatile inflation, questions around central bank independence, that has all been really reflected in a rise in term premia, which is why I think we've been more focused on that short to intermediate part of the yield curve. And I think as we've looked at a really hawkish repricing in central banks, especially from the ECB and the BOE, that leads us, I think, to focus on that 5-year and in space, because we think there's a little bit of a mispricing there without, I think, actually acknowledging that there are also downside risks to growth as a result of this conflict. So I think the market right now is focusing overly so on the inflationary risk.
But if I worry about equity markets and what is happening in terms of a scenario where we go from kind of 100 to 140, are front-end bonds the best protection against that move?
So I think if you were to see a move from 100 to 140, that's where you, I think, see some real demand destruction actually start to hit the economy, and that recessionary outcome, which would actually drive growth lower and, in our view, force central banks to cut. That actually more difficult scenario is actually that middle one where you're just in this stasis of persistent inflationary pressure.
Madison, does that mean then you see some of the European government bond markets as mispriced right now in the Euro? So do you think we're assuming too many hikes, that it won't be possible for European government bond market or European central banks rather to execute all the hikes that are priced in?
Yeah, I think that's right. And I think even within that, you are looking at different degrees of patience that central banks can employ. So when you're looking at, the ECB, they came into this conflict in a bit of a different place where they had gotten inflation back already pretty much in line with its target. Growth was actually improving. And so I think as a result of that, that means that, they might preemptively move a bit more. But 3 hikes, I think, still seems too much for us, given the fact that we haven't necessarily seen that pass through into core. What's really interesting, I think, is when you start to talk about the gilt market and what the BOE might do, given the fact that, yes, inflation is sticky, and yes, I think that you are looking at pronounced, risk around inflation expectations, but at the same time, that stagflationary type risk and the growth impact and that softness that might be felt, and we're already seeing it happening in the labor market within the UK, that to us signals that the, BOE should really, I think, consider some of those downside risks to growth in the months ahead. So I think that does look like an opportune moment for investors to consider the gilt market.
Well, we're looking at the gilt market today, and there's the catch-up from Monday, obviously. So you're seeing gilts selling off, and yields are up between 7 and 9 basis points. So 9 at the front end and 7 at the back end. And the 10-year is now above 5%, so 5.04, so levels we haven't seen since 2008 in terms of yields. And that is obviously a constraint on the Chancellor with all those fiscal ramifications of that. So how close are we to kind of calling stagnation in the UK with yields at these levels, with the energy shock and with a lack of fiscal impulse coming through?
I think we're still navigating a very uncertain environment, but I do think at the same time, when we look at the market pricing and what we know today, it does appear that, if we were to consider the fact that, yes, inflation expectations have risen, but there are downside risks to growth, for us it seems that the, BOE is more likely to perhaps hike once this year, but even might need to consider cutting next year if that were...
Do you see gilts higher from here, or...?
Of course, we could see...
Sorry, yields higher. Yeah.
Yeah, so I think that, of course, we could always see, short-term spikes higher, but our view over the course of the next 12 months is for gilt yields to fall. And so we would be of the mindset that you should be focusing on, the 5-year space and when it comes to investing.
Nice to see you. Thanks for stopping by. Madison.
Thank you.
Global investment strategist at JPMorgan Private Bank. Core 6 looks like this morning. You've got a number of big names out there that are worth focusing on. HSBC is one of them. Rheinmetall is another one. As you can see, Rheinmetall is up this morning. Despite maybe disappointing initial sales numbers and quarterly reporting numbers coming through, the outlook much more positive. The market seems to be looking there. ASML is also higher. Let's get some details on what is happening in the banking sector and elsewhere. Chloe, here with the details.
Good morning, guys. HSBC is down quite significantly, more than 5% this morning after profit missed estimates. And that was tied to a fraud-related charge in the UK, but also to other charges related to the deteriorating economic outlook because of the situation in the Middle East. And so this profit missing estimates is really dragging down those shares this morning. Moving on to another banking story, which is a little bit more positive. And we've got UniCredit hitting a record of profit thanks to fee income in particular. And that position UniCredit quite well ahead of its takeover bid for Commerzbank, and we are up quite strongly this morning, about 3% for that bank. We are also up for AB InBev, the beer company, and that is because there has been actually quite good volume growth, quite good beer demand in Mexico, Colombia and Peru, and it's also a company that's really benefiting from its decision to diversify its portfolio beyond beer as well. And so we're seeing quite good results, and therefore shares up quite strongly, about 6% this morning. Fresenius Medical Care is not having that good of a day. This is a dialysis company. It reported lower than expected profit, and that was due in particular to some weakness in the US market, which is a really key market. It was down. Now it's unchanged, but it was down at the open this morning. And finally, Vodafone is up after CK Hutchinson decided to agree to sell its stake in Vodafone 3, which is the UK's largest mobile operator, for $5.8 billion. And so we are seeing this big M&A story driving those shares this morning, and we are up about 1% for Vodafone.
Thank you very much indeed. Chloe Melick with some of the stocks on the move today. Coming up, UniCredit shares on the rise, as Chloe was saying, after reporting a record quarterly profit, while Sabadell and HSBC slump on first quarter misses. We're going to discuss the outlook then for European banks. We'll bring some more insight and more detail after the break. This is Bloomberg.
Tuesday morning, good morning, welcome back. We are 18 minutes into the equity market session here in Europe. At a headline level, actually not a great deal to report. London playing a little bit of catch-up on the sector front. Telecoms and technology, the two leading sectors. On the downside, banks and basic resources. So at least we've got some alliteration to talk about.
Yes, indeed. Let us focus on those banks then, shall we? We've got HSBC, UniCredit, Sabadell, all in focus because we have numbers out from all of these businesses. UniCredit certainly ploughing its own path. It's a miss for HSBC after Europe's largest lender set aside funds for fraud-related exposure and flagged the impact of the Middle East conflict. Let's bring in Tom Metcalf, our EMEA Finance Managing Editor, who can talk us through some of the dynamics at play here. Let's start with HSBC. Credit losses there and a big focus on what they've had to say about the UK.
Yeah, exactly, and a big surprise. No one really had in their expectations a 400 million provision against what they're describing, as a loss against a UK fraud. So a lot of question marks about who that firm is. HSBC not saying. What they have said is it's basically kind of an indirect exposure. So they have lent to a private equity firm, which is then exposed to whatever this UK fraud is. But that is really what's dragging down the shares, along with, pretty negative sort of signalling around the exposure to Middle East and, the fact that, they are expecting that situation to just kind of continue to drag on the business.
Good morning for UniCredit, though.
Yeah, very good. And, what a week, because they're just starting their sort of lowball offer for Commerzbank. So it's kind of the results that Lowball probably wanted. Yes, exactly. Definitely lowball. It's 10% below the Commerzbank's market cap.
Yeah. So does this help? Presumably this helps that process?
I think it just underlines, what a tight ship Orchel is running. And, over the weekend, they had all the shareholders basically coming out and, supporting, the move of Commerzbank. You can understand why, because, so far, everything Orchel's done, he's basically been able to achieve. So really simplified that bank, really, focused on returns. So I think it just goes to show, UniCredit's all going in one direction at the moment, the one that Orchel wants.
What about Sabadell and Spain? What's happening in the Spanish banking space for Sabadell and their numbers?
So that's the most fascinating story maybe of all, because, they just sold the TSB unit. So these results are a little bit difficult to unpick because you're pulling out all the TSB results. But again, shares slightly down. It just looks like, their whole story now is we're, kind of stronger as an independent bank. So, it's a good job we weren't bought by BBVA, and it's always interesting to see the results because, with shares down, it just kind of sort of undermine that sort of narrative a bit that they're trying to push, that, we're bigger, stronger, separately.
We are a decent way through now, the European corporates reporting season, and the banks, we've got most of the banks.
Yeah.
What are they telling us about the European economy? What are they telling us about the impact of what is happening in Iran and the credit story and the recession risk that is growing and the story around the ECB? Is there a kind of macro picture that I can take away from what these banks are telling us?
So I think there's no one through line from all the banks. Not all the banks, for example, like HSBC today, the French banks are sort of maybe overly flagging sort of, there is risks here from the Middle East, the macro picture. But that would probably be my takeaway. We don't expect kind of a unilateral approach. But the fact you got some of these big banks and the banks that most expose, HSBC, for instance, starting to raise those warning flags. I'm coming out of this set of earnings for banks, at least, a little bit more pessimistic and, not unduly, not sort of, oh gosh, it's sort of crisis time, but it's more probably sort of disappointing times ahead, I suspect, for some of these banks.
Yeah, and it takes us back to the question as to how long this conflict continues and exposure and to what extent the next quarter these kind of numbers have to be factored in as well. Tom Metcalf, thank you very much indeed with some analysis and detail around some pretty interesting bank earnings coming through today from Sabadell, HSBC, of course, and UniCredit. To the defence space now, Rheinmetall reporting prelim first quarter sales that missed expectations. As you can see, though, the stock is up 1.4%. Despite that, Germany's largest defence company expects first-half revenues to favour the second quarter, supported by truck deliveries to Germany and the resumption of production at a Spanish ammunition plant following an earlier accident. Joining us now is Bloomberg's chief Europe correspondent Oliver Crook, who follows the defence space very closely. Ollie, how surprised should we be then by this earnings miss from Rheinmetall, given the kind of the overarching theme of increased defence spend?
Yeah, I think the overarching theme stays pretty stable. I think now it's a job for investors to try to sort of manage that versus expectations because, of course, the broad macro story isn't going to change dramatically. So I'll go through some of the numbers here we got from Rheinmetall in the first quarter. As you say, revenue estimate that missed estimates, $1.9 billion. It was estimated to come in at 2.3, so a miss of about $500 million on the revenue side. But again, looking at full year sales, the expectation is still to be up 40 to 45% this year. You look at the margins, they came in at in line with expectations at 11.6%. 6%. But again, operating margins for the full year still projected to go up to 19%. And again, when you look at that all-important backlog, this is how much is sitting on their order books, 73 billion euros in the first quarter of this year. But again, we're looking at the longer term for Rheinmetall. As you can see there on the screen, 1 year it's down basically 13%, down about 10% this year. But again, going back to the beginning of the war in Ukraine, the beginning of 2022, this is a stock that's rallied 1,570%. So again, the broad story is still intact, but there's going to be some more adjustments in pricing.
Yes, and Ollie, there's a lot of expectation then in that broad story that increased government defence spending is going to have an impact on this business and on this sector. How far through that story are we?
Yeah, we're still in the sort of foothills of that. We're still at the very beginning of that. That German funding, you know, we're talking about defense spending over the next decade or so. But again, the question is how much of this has the market already priced in? Are we sort of past the peak for a lot of these names within the European defense space? What I thought was very interesting was that after this war in Iran began, you didn't really see a rally at all in European defense stocks. You see it as relatively flat. And in fact, that's the case for many of the stocks that we saw over in the United States. So I think there is a much broader question, despite the fact that these sort of tailwinds remain intact for the industry, that maybe the market kind of got to where it needed to get in terms of the pricing. Again, we could obviously see that reprice pretty radically given just the moves and the shifts that we've seen so far. But again, the story for the last year has been more trading sideways.
OK, we're not done yet. Leonardo's coming up. Hensoldt's coming up. Ollie, any expectations? What should we be looking for?
Yeah, for Leonardo, what's very interesting is you had that reshuffle at the very top. You had Giorgia Meloni effectively replacing the CEO of Leonardo because of some of the differences that they had. You know, the former CEO really seen as a sort of independent thinker, not really taking his cues from the government, something that Meloni really pushed back against. So now you have a new CEO replaced about a month ago. So you're going to get some new direction potentially in terms of the guidance, where the business is going to go and what his sort of vision for that business is. And of course, Hensoldt, something that we watch very, very closely. They do all the radars, the kinds of things that you're really going to need if you're under missile attack, which of course has been part of the story in the Middle East and out of Iran and many of the other Gulf countries that now need to have improved sort of surveillance, sensors, but of course air defense. So that's a conversation we'll have with the CEO of Hensoldt tomorrow to see kind of how the war in Iran has changed their sort of picture for their business and what they're pushing into.
Mr. Crook, thank you very much indeed. Our Chief Europe correspondent, Oliver Crook, joining us from Brussels. Stay tuned. We are going to have that conversation with the CEO of Hensoldt, 6:15 a.m. London time tomorrow morning.
Yeah, it's really interesting, isn't it? The timing with which this defence spending is secured and comes through, and whether that matches up with what investors are expecting or not. We've seen incredible gains for these defence companies, but volatility could also be part of that understanding.
Yeah, and Guy's been talking about the fact that these are quite chunky and they come through lumpy, I think is the way to describe it. They have this massive backlog, and they still see earnings going up to 19% from around, 11% now. So the margin story improves. They have that backlog, but it's getting it out.
They're trading on massive multiples, these stocks now. We've come a long way very, very quickly. So you've got to deliver now.
Absolutely. So we'll look to the earnings story to continue to do that. Coming up on the programme, could technology actually be a boon for private credit as asset managers seek to calm anxiety around exposure to software firms? We'll get into that conversation with Mark Pinto from Moody's Ratings next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. If you were to strip out the FTSE 100, this would be a pretty optimistic look across the equity markets, specifically particularly compared to yesterday, with losses around 1%. Today, across the benchmark, you're seeing gains of 0.2%. Over in France, you're seeing upside of around 0.4%, and the DAX in Germany adding 111 points so far. But the FTSE 100 is challenged, down 0.9%. There's the catch-up play, of course, closed yesterday for the bank holiday Monday, but also the banking sector under pressure today, led by the likes of HSBC. Guy, what are you seeing?
OK, let's talk about what we're seeing internally within these markets. 422 up, 163 down. So basically 2-1 in terms of the gainers versus the losers this morning in Europe. But you've got to think about how bad yesterday was and then factor in what we're seeing today. Volume is a little higher, actually. Yesterday, obviously, with London out, very, very low, so we're kind of bouncing back a little bit there. Let's talk about some gainers. AB InBev. Apparently, we're drinking a lot of beer in Mexico right now. There is a World Cup coming. I'm going to factor that in as well to my thinking. Hugo Boss is also trading higher. Unit Credit is the one I want to focus on. It is up by 3.23%, really delivering. Really solid numbers coming through in terms of what we are getting out of that company right now. Does it encourage, therefore, the idea that it would be a successful owner of a German bank? which is kind of quite interested in Frankfurt. Fresenius is tracking a little lower this morning. HSBC also low. Just want to kind of just think about HSBC. UK banks are down today. Let's call it circa 2%. So just back that 2% out of the HSBC number just to get more of a real look, because London was closed yesterday. So the London market is down. HSB is down more, but I think you've got to kind of factor in the initial down bit when you look at what we're seeing in terms of the numbers on the screen today. And Rio is also softer today, down by 2.2%. London is playing a little bit of catch-up, Anna.
Guy, let's get an update on some of the other stories we're covering this morning. A fragile 4-week ceasefire in the Strait of Hormuz hangs in the balance after the US and Iran resumed armed hostilities in a flare-up of violence that has also drawn in the UAE. The events have prompted calls for the US and ally Israel to renew attacks on Iran, with the US Senator Lindsey Graham saying Tehran's choice to attack the UAE and cargo ships, quote, more than justifies a big, strong and short response to inflict further damage on Iran's war machine. Australia's central bank has raised its key interest rate for a third consecutive meeting. The policy committee opted to increase the cash rate to 4.35% by a vote of 8-1, unwinding all of last year's cycle of monetary easing. The move underscores its determination to tame stubbornly strong inflation and cements its outlier status among global counterparts. And Bloomberg has learned that Apple is considering using Intel and Samsung to manufacture the main processors for its devices in the United States. Such a move would reduce reliance on longtime partner TSMC. Sources say talks, however, have not resulted in any orders so far. Guy.
We'll watch that space very carefully. Let's turn to what is happening in private credit right now. Apollo's John Zito has told Bloomberg that the asset class is the safer place to be as the rise of AI dramatically shifts the environment for, quote, the whole ecosystem of investing. It comes as more investors in business development companies have tried to redeem their shares in recent weeks.
For whatever reason, everyone's acknowledging that we're going to be in a higher vol regime, but they're not acknowledging that credit is actually typically been the safer place to be.
Yes. OK. Well, we're going to kind of take that thought and run with it a little bit. Mark Pinto, Global Head of Private Credit at Moody's Ratings, sitting next to us this morning. Good morning.
Good morning.
How are you feeling about private credit? Is this a safer place to be right now?
Well, I can tell you it's certainly an area that's going to grow and continue to grow.
Yep.
The elevated redemptions, as you just mentioned, within the context of the perpetual non-traded BDCs, a very small part of the overall private credit ecosystem, are likely going to continue. But what we learned from this episode is that the structure worked. And that's what I think is really important.
Do we know yet if the structure works? We haven't been through a credit cycle in quite some time.
Right.
The feeling is that maybe we're about to get one, or there's one in the not too distant future. Can I give private credit a tick in the box until we've been through that?
I don't think so. In fact, what we've just gone through now with the elevated redemptions is a test. It is not the test. So this is all about underwriting at the end of the day.
Yes.
And the question is whether or not the private credit lenders have been disciplined. I think one of the things that we've been focusing on recently is this software exposure within the BDCs. So roughly 25% of the average BDC that we rate at Moody's is in software. And as we know, the only free lunch in investing is diversification. And it doesn't feel like when you have 25% of your portfolio in one sector, that doesn't feel very diversified.
And so what do we know about that underwriting and the underwriting discipline? Then, Mark, what do we think we will see as we start to learn more about the underwriting standards that have been applied here?
Well, we are going to see some deterioration, but from a pretty strong point. So if I look at the perpetual non-traded BDCs, it's not a very seasoned portfolio. And if I look at the number of troubled borrowers in that particular cohort, it's just 0.5% are troubled borrowers today. That's likely to normalize, mean revert. And the question is whether or not this goes beyond that. And really only time will tell.
Only time. So that sounds like a small number. Is that the number I need to know if I'm thinking about whether anything that happens in private credit becomes systemic or not?
Yeah, well, let me contrast that with the publicly traded BDCs, which also have a significant exposure to software. There, the troubled borrower number is about 2%, so significantly higher, but it's down from 2.5%. If you look at the software companies today, they have performed quite well. Their revenues are quite strong, but that's somewhat rear view mirror looking, right? So I think what we're going to focus on going forward are billings and client retention. I think these are two early indicators to figure out whether or not these software companies that have been underwritten have staying power.
You've talked about, Mark, you've talked about the fact that you've talked recently about the fact the sector's faced a liquidity crisis, but not yet a credit crisis.
Correct.
What takes us from a liquidity crisis to a credit crisis?
Well, I think the liquidity crisis, if you will, this was a test, and I think the test was passed. Now what we're doing is we're focusing on these troubled borrower numbers, right? So we call them non-accruals. We'll just have to continue to watch very closely. What's interesting, in the public bond markets, we're seeing defaults come down, and there may be somewhat of a lag in the private credit market. So we typically had thought that maybe when the credit cycle turns, it would turn for everyone at the same time. But it doesn't seem like the two markets are working in sync. So we'll continue to compare and contrast the default numbers we see in the public market as well as default numbers we see in the private markets.
Okay, so there could be kind of match up at some point. There will be a signal. Do you expect to you see the sector growing?
Yes.
And growing from here?
Yes.
But do we also see more redemptions until this is cleared out? Yeah,
I think within the BDC market, we will see elevated redemptions between now and the end of the year. But whereas we saw somewhat of a inconsistent response by the private credit lenders, some were meeting requests at 5%, some at 7%, some at 10%, some at double that number. I think going forward, you'll see a more consistent approach where they'll meet at 5% regardless of the number of requests that are made. They'll meet at 5% and they'll continue to move on from there.
You said a bunch of quite interesting things. I just want to follow up on a few of them. The industry is going to grow.
Yes.
Who is going to grow the industry? Where does the money come from that is going to grow the industry? Because there'd been this kind of assumption that institutional money was kind of reaching its limits, and that retail was going to be the next kind of growth leg of this industry.
Yeah.
Does that transition now not happen? And if so, kind of have we reached the limits on institutional?
I would say we haven't reached the limits, and it depends where in the world you are. So in the U.S., we've seen a lot of money from retail investors come in the last 5 years. The numbers are somewhere between $200 and $400 billion. I think there is slightly in retrenchment mode, but I think going forward, we could see them come back in and come back in even a bigger way. The Trump administration recently had an executive order, which the Department of Labor responded to, that would allow private assets into the self-directed retirement programs in the U.S. We call them the 401ks.
Is that a good idea?
I think if it's managed in the context of a target date fund where it is professionally managed, where you or I or my children are not directly going into a private credit fund, but are being helped by an institutional portfolio manager, I think over long term, that could be something that could enhance portfolios.
Right. And so how does that retail investor experience of gating that we've seen recently, what have we learned from that particular dynamic, Mark? Have we learned that retail investors didn't understand the risks and now they do? Or what's the story?
Yeah, I would say that this was a lesson for both the industry and retail investors. What the industry learned is when you take in retail money, that comes with certain risks. So you need to take in that money, and there has to be care applied to that. I think what investors learned is that investing in a private credit fund is not like investing in a mutual fund. You can't put your money in on a Friday and take it out on a Monday. So I think it was lessons learned all around, but the disclosures were there. Whether or not they were read or not is another story. It doesn't appear that everyone read them.
Yeah, it's been an education, hasn't it? We're also being educated, it seems, in the hyperscalers and their tapping of private equity in some cases to build out the capacity to kind of move AI forward.
Yeah.
What stands out to you from that dynamic? Are there any risks that are being overlooked? How comfortable are you with the fundraising in that area?
Yeah, so a couple of things. One, John Zito was just talking about this. When he's talking about software and AI, he's talking about the data centers. We at Moody's think that there'll be north of $3 trillion spent on data centers over the next 5 years. The original deals that came out were non-investment grade rated deals from investment grade rated companies. So the Mag 7 are very highly rated for the most part. But what they're trying to do is remain asset light, not asset intensive. So they were building these things, and the original deals were non-investment grade. What we saw is that they would dwarf the non-investment grade market if they were to push all of the debt there. So they had to change the structure of the deals, whereby some of the risk was absorbed by the Mag 7 company themselves, whether it's force majeure or insurance. And so I think you're seeing better deals today, investment grade deals, and they have to be investment grade deals in order for them to attract as much money as they would like to. This is a huge build out we've not seen since the railroad build out at the late of the 1800s, early 1900s in the United States.
And it was the debt that caused the problem in that build out of the railroads.
We're going to have to see. There's a lot of scale. There's a lot of investment going on here. The other big difference between the railroads and the data centers is railroads we still have today, right? Data centers, will the technology change and will you end up with stranded assets? We don't think right now you will. We think they're building to what is needed. In fact, there's more of a concern about underinvestment than overinvestment today, but that could change very quickly.
So we've talked about data centers, we've talked a lot about tech this morning. We were also just having a conversation about defence and about the mismatch of expectations, perhaps, from investors on how quickly these opportunities are going to materialise for defence names. Private credit is an area that is interested in defence opportunities, and defence companies are turning to private credit. How does that story evolve?
So there are really four major tailwinds that we see for private credit going forward, particularly in Europe, right? So post-Liberation Day, I like to call it Liquidation Day because that's what it seemed to happen then, you've got a tailwind of defense spending, sustainability, transition, and innovation. And all four of these things require a lot of money. Necessity is the mother of invention. Here in Europe, banks dominate. It's nearly the only major source of financing. Regulators actually would like to see more options. Private credit can come in, provide long-dated financing that is bespoke, and that can be done very quickly. And I think you're going to see them really play in these areas.
What's the catalyst to get that done then? Is there something that happens at the regulatory front, or is there something in the markets that changes that dynamic, that brings more private credit into Europe to fund that kind of build out?
Yeah, it's a combination. We recently had a private credit conference here in London, and we had a regulatory panel because regulation is so important to this market, whether it's how to bring in retail investors or how to make sure that when insurance companies invest in private credit, they're doing so in a responsible manner, or how banks lend to private credit funds. Regulators are going to play a very big role. We had someone from the ECB as well as the Bank of England, and I can tell you the session was both scintillating and all about regulation. Two words
those two things don't go together.
You never find those two words in the same sentence.
Is this a stigma that it needs to get over in Europe, private credit?
I don't know that it's a stigma. The market is less developed here than it is in the U.S. U.S. banks are used to being disintermediated. We're used to innovating. In fact, in the U.S., banks only provide 25% of the financing of the economy. The opposite is here in Europe. 75% plus is provided by banks. I think in order, again, to meet the capital needs that Europe is facing, they will need more innovation. I see regulators more as backers than blockers, but they want to see this segment of the market grow in a responsible fashion.
Mark, very interesting. Thank you very much indeed for joining us around the set. Mark Pinto, Global Head of Private Credit at Moody's Ratings. Coming up, the US and Iran exchange fire in a flare-up of violence, casting doubt on the fate of a 4-week ceasefire. The latest next. This is Bloomberg.
This is the opening trade. Now, the US and Iran exchanged fire in a flare-up of violence that also drew in the UAE. All of this in the past 24 hours, prompting calls for renewed strikes on Iranian targets and casting doubt on the fate of a 4-week ceasefire. The US military says it fought off attacks from Iranian drones, missiles and armed small boats as it facilitated the passage of 2 US-flagged vessels through the strait. Oil is edging slightly lower after sharp gains on the fresh round of hostilities. The US president striking a positive tone, saying prices could be worse.
Can't let Iran have a nuclear weapon. We hit all new highs, and I said we have to take care of business because we can't let that happen. So we did a little detour, and it's working out very nicely. They thought that energy would be at $300, right? $300 a barrel, and it's like at 100. And I think going down, and I see it going down very substantially when this is over, Chris, and I think very rapidly too.
Let's bring in Bloomberg Horizons anchor Germana Pesetti, who can take us through, Germana, the latest flare-ups and the stress that the ceasefire is very obviously under right now.
Yeah, that's right. I will tell you, though, this morning it has been quiet in the region. Again, it could be the calm before the storm as we wait for President Trump to wake up. But yesterday was a very different situation. And hours after President Trump announced this new plan, Project Freedom, to help guide vessels through the Strait of Hormuz, what you started seeing was repeated attempted attacks on vessels that were looking to pass through the strait. In the afternoon, we reported on an ADNOC vessel. This is the energy company of the UAE that was targeted by one of those drones from Iran, causing a fire there. Later in the evening, UAE residents, and of course I'm one of them, we live here, we received multiple missile alert texts, and this is the first time we received these texts since the ceasefire went into place about 4 weeks ago. Later in the evening, the Ministry of Defense said that they had intercepted 14 missiles and 4 drones in the course of 12 hours. And again, one of those drones managed to intercept the air defense system and cause damage at an oil export terminal in Fujairah. So that really takes us back to sort of the status quo that existed around the time of the war. Now, as I mentioned at the beginning of this, it has been quiet this morning, and there are questions about where we go from here. Obviously, you know, the battle had moved to the strait, so to speak, with vessels attempting to pass, with the U.S. saying this morning that 2 of their destroyers had managed to navigate through successfully. But I think what's happening there really underscores the serious amount of danger that ships and ship owners would be subjecting themselves to should they want to make that move, even with this new project that was put in place by Trump. And at the same time, the Iranian side have come back this morning, once again insisting that there is a new protocol. The Ghalibaf, the Speaker of the Parliament, was saying that there's a new equation for the Strait of Hormuz. And the Iranian foreign minister also saying this morning that there is no military solution to a political crisis. Project Freedom is Project Deadlock. So once again, we are in this impasse. But we have to wait and see what the U.S. decide to do from here. Should they go down the military route, or once again try to pursue the path of diplomacy, maintain the blockade in place in hopes that it will push Iran to make further concessions?
OK, tensions are clearly very high. Still, Bloomberg Horizons anchor Germana Pesetti, thank you for that update out of the region. Let's look ahead to what else we are watching throughout the day. ECOFIN ministers will be meeting in Brussels. The Milken Institute Global Conference continues. We're going to hear from BlackRock's Larry Fink and Brookfield's Bruce Flatt. And at 3 p.m. UK time, data out of the US, ISM services and jolts on the labour market front, and earnings out of the US. Pfizer before the market, and AMG, of course, with a gauge on the demand for AI accelerators. And later on the macro front, Fed speak from Michelle Bowman and Michael Barr.
Yeah, lots coming up. Still plenty to think about as we work our way through this week. Let's get a kind of sense of where we are, though, this Tuesday morning. Oil has climbed and has stayed reasonably elevated. Yields are elevated. Equity markets are having a little think about what comes next. Bloomberg M Live, Adam Linton joins us now. If I can get that out. Good morning.
Good morning.
So the UK comes back. We've had fighting in the Gulf yesterday. We've got yields in the US that are kind of on a 30-year tenor now at 5%. Oil is up. Can equity markets continue to look to tech, or do we now have to spend a little bit more time thinking about what is happening here?
I think if you look at different regions, you get a bit of a hint of to what's actually going on. So, you know, in previous shows, we've talked at quite a length about how Europe has a relatively meagre tech sector. So if you look at that, that kind of essentially strips out the tech effect for you. And, you know, if you look at, on a 1 month chart, since the ceasefire, we saw, initial pop higher, but since then we've kind of drifted a little bit lower. So that's kind of a tell that clearly something is acting as a drag on Europe. Europe's, economic exposure to high energy prices is a concern. We've seen, the back end prices of the oil curve continue to move higher. ECB expected to tighten in, and then you've also seen this kind of trade salvo between Europe and the US, Trump threatening the auto sector. So I think if anything ex-tech, I think is clearly vulnerable at this stage. But if you look at, Asia, which also has economic exposure, that's been, on the 1 month basis, far outstripping Europe, and the bounce back is even, rivaled that of the US. So for now, it does appear that, tech sector is enough to keep things going.
Let me talk to you about FX then, Adam, because this has been interesting. There are some periods where interest rate differentials really matter for currencies, and there are other periods where they don't seem to be in the driving seat. And we spoke to an FX guest earlier on who was saying even if we get hikes from the Eurozone, that's not going to support the euro particularly, because the market is going to focus on something else, not just that higher interest rate. How are you thinking about the development there?
Yeah, I'd agree to that fact that, higher interest rates aren't necessarily going to provide support for the euro here on in. Obviously, one thing we're looking at is, the potential growth impact of higher energy prices, moving higher along the curve. That's obviously clearly a headwind for the euro. And as I mentioned to Guy just then, at a time where European industry is already struggling, we've now got the US saying they're going to potentially impose tariffs on certain aspects of the euro area economy. And, we've seen, warnings of stagflation. That will temper some expectations of how much more hawkish repricing we can have for the ECB. It looks relatively toppy at the moment. And, as I was saying to Guy and Tom on Friday, that, if you get a rerun in 2011, we see these interest hikes, unwound relatively quickly, then that would be euro negative. I think if there is an interest differential story, it's actually probably from the US. We're seeing traders ratchet up expectations of, the Fed to potentially hike rates, rightly or wrongly. We don't necessarily know at this stage. US is a lot more economically resilient to higher energy prices. And, it definitely looks as if risks are potentially tilting to downside for euro dollar. Obviously, dollar yen is a huge risk to that call. If you do get more pronounced move lower in dollar yen, that would be definitely a headwind. But, we've seen from the intervention effects so far, they've been relatively futile. So it doesn't appear to be too much of risk on that front.
So, Adam, we saw the 30-year in the US the yield crossing 5% yesterday. Is there another level that you're looking at, either for the 10 or the 30? I mean, there's implications for the US mortgage market. Maybe that's a constraint on Trump's actions. Is there another level that you're looking at in terms of how far this could run the bond sell-off?
I think it's not necessarily an impact of specific levels at the moment. I think it's momentum. I think if things really feel like they're getting away from us, then that's definitely going to be a cause for concern. Like you said, the 5% thresholds in the 30-year, that's clearly a news headline grabber. But I think, if you see things getting out of hand and Fed tightening expectations fractured higher, then that's clearly a cause for concern.
Adam, thank you very much indeed. Adam Linton of Bloomberg M Live. We have the Milken Institute coverage. That continues, of course. That's it for the opening trade. The Pulse is up next. This is Bloomberg.